Hello, hello. Good afternoon and good evening. Hope you all are doing very well. Today is December 8th, 2025. Welcome to my channel. My name is Mike Patel and my channel name is Home Savvy Central. Many of you have come here and come every week. I appreciate it. And if you're coming here for the first time, I really appreciate it. Thanks for visiting my channel. And we have an exciting topic today. And I'm going to wait a few seconds for people to join in as they come along. So bear with me. Let me see here. I need to go to Instagram and I'm going to connect to a couple of other websites so more people can join in. So again, today's topic is, while we are waiting for some people to come on, today's topic is experts predicts a housing crash worse than 2008. Wow, that's a heavy topic. So let's see. Let me see. I want to make sure that people can hear me. I just want to go to my channel here quickly. Bear with me just a second. All right. If you can hear me, just give me a note that you can hear me, or if you cannot hear me, I'm pretty sure you can. Let me see here. Just want to make sure. Sorry about that. I'm waiting for a few more people to join in. We don't have anybody on yet. Somebody came in and backed out again. Maybe they got disconnected the phone. So just give me a minute. Go to Instagram quickly. All right. So I'm assuming you can hear me loud and clear. If not, just let me know in the comment section and I'll be glad to adjust any of my settings over here. So let's get started. Again, today's topic is experts predict there's a housing crash worse than 2008. Now, this topic or this article or this headline is very confusing because experts are predicting the crash will be worse than 2008. But the big question is when? When is the crash? Is it in 2030, 2032, 2026? We don't know. So I'm just not sure. So let's talk about it. And the way I want to show you today is, rather than me talking about what I predict and what my situation is, I want to make sure that the information I give you is legit. So I'm going to share a screen with you. This screen that I'm sharing with you is an article from Newsweek. As you can see, this article is from Newsweek. It came out on November 25th, just about 2 weeks ago. So it's pretty recent. And it says that the price correction worse than 2008 coming to the US housing market, as told by analysts. And the analyst they're talking about is somebody that I've recently come across. I've been watching her. Her name is Melody Wright. And what this article says, Newsweek says, is that the US housing market is going to face a price correction worse than 2008. By the way, that 2008 correction was what they called a 100-year correction. I don't think that statement is true. Of course, that is my opinion. I'm not arguing with anybody. But I was there in 2008, and I had read all the reports, and I had seen the recessions 20 years before that, or 30 years before that. Not seen them, but read about them. But the 2008 crash was a monster. And I personally don't believe we're going to see a monster like that, because the numbers just don't add up. But these experts, so-called expert, the US housing market is going to face a price correction worse than 2008. Wow. According to housing analyst Melody Wright, who expects home prices to drop in half starting as soon as next year. Wow, 2026. I don't know. But hey, this is a report. Who am I to say that? If Newsweek interviewed them or interviewed this analyst, she must have some say to it. Let's just wait and see. In the meantime, let me see here. Let me go on further. Let me just text somebody, see if they can hear me or not. Just give me 1 minute. Okay, so again, continuing on this article, I see it happening over several years with the potential to deteriorate faster than in the last cycle, she told Newsweek. For instance, Prices did not bottom until 2012 during the last cycle. I believe we could get started in earnest next year on the price decline and see a rather large drop historically speaking, but think it could take several years to bottom. Wow, amazing. In the meantime, if you have any questions or if you want to comment, let us know. Yes, I'm getting a... Okay. I'm just assuming you all can hear me, so I just want to make sure. And I got a comment that the music is on, so I'm going to turn off the music. You don't even hear the music. So let's carry on with this article. Okay. At the national level, the vertiginous price growth that characterized the pandemic years have also slowed to a grind, with the median sales price of a home in October only 1.2% higher than a year ago, according to Redfin, at $439,701, which is pretty much $440,000. By the way, if you're watching and if you're watching us live, let us know what's happening in your marketplace. If you have any questions, I'll try to answer what I can. But again, these are predictions. They're on a national level. And of course, as you know, the market is very local. So what could be happening in Anaheim Hills, Orange County, California, where I'm at, could not be happening in Austin, Texas, where things are really going down. Prices have really gone down. A lot of Texas cities, Houston, Dallas, Austin, Frisco, towns in Phoenix, Scottsdale, Arizona, towns like Naples or Punta Gorda or even Palm City or Palm Beach, Florida, where markets are down. So what's happening in some states doesn't necessarily happen in California. So the market is very local. So what we are talking about is on general and on average based on these analysts. So let me read further on. They're saying that according to a new report from Zillow, 53% of all US homes lost value over the past 12 months, the most since 2012. Well, the thing is, if you're a buyer, it may be a positive or an advantage for you because the prices have actually lost value, which means prices have dropped. By the way, interest rates has dropped as well. So you're at an advantage. But if you are a seller like myself, I've been in my house for a long time, then the way I see it or a typical seller sees that is any drop in the price is a drop in my equity, which is a drop in my net worth. So that's a big concern. And a lot of the sellers today don't want their prices to drop. But as Zillow says, 53% of all US homes lost value over the past 12 months. Now, I know that a lot of the owners like myself, I've been here almost 30 years and my house has more than quadrupled. A lot of states, homes have doubled or tripled in the last 10 to 15 years. And in the last 2 to 3 years, depending on where you are, home prices may be up 20, 30%. But the people who bought last year or 2 years ago or in 2023, late 2023, who paid peak prices, they are seeing a drop in their prices. Like I mentioned earlier, certain cities in Arizona, in Texas, in Florida, in Tennessee, South Carolina, a lot of those cities, some of those cities are actually seeing a price drop. If they bought 2 to 3 years ago, they're not seeing a price increase. So their net is already down. While affordability has slightly improved, however, millions of Americans are still being kept on the sidelines of the housing market by higher home prices, property taxes, and home insurance premiums, as well as still elevated borrowing cost. So I'm not sure what's happening in your area, but several things are happening. Number one, there's a lot of articles out there that home prices are coming down. There's going to be a market crash. There's going to be a slowdown. So we hear this over and over again. But one thing is for sure, what's happening is for the people who bought at peak times and the first-time buyers who bought, especially with an FHA loan or a low down payment, or they barely qualified, we are seeing a lot of defaults. So yes, the market is slowing down in certain ways, but I'm going to show you another article where they're saying that the market's going to go up. So there's two sides to this equation. Is it going to be as bad as 2008, number one, or is it going to be bad at all? On the other hand, is the market actually going to go up? And there's an article from NAR, which is the National Association of Realtors, which I'm going to share with you shortly. But I just wanted to show you that if you're a buyer or if you're a seller, or even if you're just a homeowner concerned, be careful, be cautious, uh, who you believe, what you read, what you don't read. Today, there's a lot of news. Let me rephrase that. Today, there's a lot of fake news, a lot of fake social media posts, a lot of influencers who think they're experts and they're not. I'm a realtor sharing data with you. I'm not predicting anything. All I'm doing is sharing you articles and facts and stats, and then you decide what best for you, when it is best for you in your area. So that's all I'm doing. So I'm no expert myself, but I just want to share some articles because we get asked questions a lot. I do YouTube videos and people ask questions, and this is why I share this live. And I want to do it live so that if you have any questions, feel free to ask and I'll be glad to answer that. So coming back to this article, it says that I think we're going to correct all the way to a point where household medium income matches the home price, the medium home price. And so that is going to be worse than 2008. What they're saying is that home prices have come so low that it'll be equivalent to the medium home price. I'm not sure where they get that data, but I think that's way off. But that's just my personal opinion. And so that is going to be worse than 2008. This could devolve a lot faster than last time, Wright said during an interview with Adam Taggart, host of Thoughtful Money, published on YouTube. Again, you can check it out. Wright, which is Melody Wright, told Taggart that while it is hard to say whether home prices at the national level have fallen this year, you can definitely see the deceleration happening. Yes, we have seen a lot of struggle. We have seen home price drops in certain areas. Let's look at this chart, and I'm going to go jump back on this channel here. Okay. Again, like I said, if you have any questions or comments, please put them there. And I'm not sure if you're watching on Facebook or if you're watching on Instagram. I'm not sure if you write a comment, if I can see those or not. So if you really want to make a comment, you may want to go to my YouTube channel. It's called At Home Savvy Central, HOMESAVVY Central, At Home Savvy Central, and make a comment there. But if you're on Facebook or Instagram, try to make a comment. And if I can get it, I'll try to answer that. If not, just redo it, and you can go on my channel to do it. So let's get back to this article, to this chart over here. It shows what's happening with the home prices, medium sales price of homes sold in the United States between quarter 2020 and 2025. As you can see, in 2020, pretty much at the pandemic levels, where the medium home price was 317 at the peak. And this is when October 2022, it peaked at $442,000. This is a medium home price of USA. Then it went down, it's back up, down, up, and then it's back down. As of first quarter of 2025, the medium sales price dropped to about 410. It used to average for the last 2 years about 430, 420 to 430. So it has dropped, I would say, significantly from a high of 442 to a low of 423. That's almost $20,000 drop on a medium price, which is pretty significant. So let's see furthermore what this article is saying, and then we will move on. It has been a difficult year for the housing market. While price growth has stalled, home prices remain much higher than they were before the pandemic in much of the country. In April, what Wright calls the tariff terror caused many buyers to have cold feet and delay home purchases while waiting to see what the impact of President Donald Trump's policies would be on the U.S. economy. The only transaction that continued happening in the U.S. market at volume this spring and summer, she said, were for the higher priced homes. You have this bifurcated housing market, but the majority of folks transacting are in these upper tiers, so your medium home price is going to be higher, Wright said. I'm going to read one more paragraph because I want to get an understanding on this. However, what I've been seeing over the last 3 months, and that is I get into dirty details underneath the covers, that $100,000 to $250,000 sales price, we are starting to see incremental increases in sales in that category. And so it continues, it will start to drag the medium down. It's happening already, and that's where we're seeing the deceleration. Right said, adding that we are going to end the year with flat home price growth. So yes, we have seen that also, and I've read other reports. The medium sales price is not an average sales price. So the way they calculate is look at the highest prices and the lowest prices, then they come to a medium. And of course, in states like California or cities, metro cities like Silicon Valley, Los Angeles, New York, Miami, Chicago, a lot of those most bigger states, the home prices are pretty high. My medium home price in Anaheim Hills is around 1.1. It used to be higher, 1.2, but it's around 1.1, 1.2 range right now. So if you compare to the medium sales price, we're a lot higher. But what Melody is saying that recently, because of the higher interest rate, because of the home prices, and especially the northeastern side where the homes are much cheaper than other states in the mid and southern states, homes are selling a lot faster, a lot quicker, and in higher numbers, but they are lower priced. She said it's in the 100 to 250. I can't even imagine there's a house for $250,000 out there. So I just can't believe where those homes are, but they're out there. So what's going to happen is as more and more homes sell, it's going to drag the medium home price down. And as the higher homes slow down, that's going to drag it down as well. But let's see what happens. Clark has a Clark, thanks for joining in, Clark. Appreciate it. Yes, some prices have softened in Metro Atlanta, but like you said, Mike, real estate is local, so you have to dive into the data in your area to see how homes are doing. By the way, just to let you know, Davon Clark has his own channel, so please join him. He's on Sundays. Davon, if you can put your time there, I'll be glad to promote your also. And he's been a guest on my channel as well. So yes, appreciate it. You are right. I just want to make a comment. Market is local. Got it. Okay. Cool. Okay. All right. Let's move on. I want to move on to something else. Let me see here. Where? Let's see. I don't want to show you this. I don't know what this is. Huh. Okay. I'm gonna not share the screen. Sorry about that. All right. There we go. Okay. So the thing is, from let's summarize what Melody Wright is saying. And of course, this is only her prediction, and this is a prediction from one person. So I don't take any prediction from one person, but this was significant that it was in Newsweek. So I thought I would share it. So the conclusion is that Melody Wright and of course Newsweek are saying that home prices may fall up to 50% starting next year. Wow. Believes incomes and home prices must realign. I don't agree with that. I don't agree with the first statement. Points to rising inventory and weaker demand are early signs. She's absolutely right. Two things are happening. Home prices are dropping in certain areas. Most of the sun belts, all the home prices are down because the inventory is very high. In certain areas, including California, on average, inventory is up, depending on where you are, anywhere from 20 to 40% higher than last year. Now, that's nothing to panic. We might say, oh my gosh, inventory went up 30%, 40%. But if you look at the averages, we're still way down from pre-pandemic levels. So the inventory right now, of course, local markets, it may be high in your area, but it's still less than the pre-pandemic levels, doing the normal levels. So yes, inventory is up. Home prices may be slowing down. Doesn't mean there's a crash coming, because historically, we are still very low on home inventory. All right. Yeah. So Devon is saying that, I'll put it on there. The channel is Clark the Realtor, and he goes live on Sundays, 7 p.m. Eastern time. So if you guys want to join and check his channel out, feel free to do so. So again, going back to Melody Wright's summary, the last point I want to make is that she warns that investors could pull back, adding downward pressure. I already think the investors have pulled back. And the reason I say that, based on reports I've read and shared on YouTube, on my YouTube channel, is that a couple of years ago, especially in 21, 22, 23, when there was a lot of inventory and a lot of people were not buying, and the banks and everybody had some properties, or if they had a portfolio, they sold it to investors. A lot of investors bought cheap. A lot of the private equity bought homes, especially in Atlanta. And Devon, you can he can vouch on this. Surrounding of Atlanta, there is so many investors, private equity, Wall Street companies, including Blackstone. They've bought thousands and thousands of properties at very cheap prices. They fixed them up, raised the rents. When the rents went up, they sold it and raised the home prices. Now they're not buying anymore, or they're dumping those properties because it's all about cash flow. So rather than all those homes sitting, they're selling, they're making profit. So that's why Melody, I'm assuming, saying that investors may pull back. I personally don't think investors pulling back will make any difference, because they're going to do what they're going to do. And if foreclosures come, and there's very few coming, investors are buying those properties in bulk, 100 at a time, 400 at a time. And so when my friends and my clients call me to say, hey, Mike, find me a foreclosure, I tell them, call me in 2 years. Because in California, I don't see any foreclosures coming in 2 years. And even if there are any foreclosures, the institutions, the banks, the lenders are selling it to these private equity firms or Blackstone or Wall Street companies, because they give them all one time, 100, 200, 300. So we don't even see it. So I don't think they are buying those properties privately, but I don't think we should. I don't think we're going to see any impact of investors not buying. At least not a huge impact. Clark is saying that investors are definitely pulling back in the Metro Atlanta area and reorganizing the portfolios. They are now liquidating some of their properties. Exactly. Yep, that's exactly what they're doing. So now here's the thing I wrote down here. Big drops can happen in specific markets, but a nationwide 50% collapse would require a 2008 level financial breakdown. And today's data does not show that. So let me just briefly explain to you, for those of you that were not around in 2008 or not what's happening. One of the reasons that the 2008 housing market crash came is because there were a lot of toxic loans. There was lots of toxic loans, and everybody, as the prices was going up in 2000, 2001, 2002, 2003, 4, 5, the home prices kept appreciating. So what homeowners did at that time was they kept refinancing. But what they did was they kept pulling money out. They kept pulling money out. So when the prices were higher, their debt was high. So when the market slowed down, there was no equity, and people lost jobs and they could not sell their homes because there was no equity. So what happened is in 2008, there was an inventory of almost 11 months supply, which means if all the homes it took 11 months to sell all the homes. Currently, we're averaging about maybe 4 months at most to sell all the homes. Furthermore, right now, all the buyers, all the homeowners in the last 10 years who just refinance. A lot of them did not pull out equity. So right now, we're sitting on tons and tons of equity. So even if, let's say, I lose a job, or somebody loses a job and does not pay the bank for a year, and then they sell it, even after selling, even after not paying the mortgage for 12 months, they can still sell and come out ahead and walk away with a normal sell and not going into foreclosure. So that's the difference. The difference is right now, most homeowners have a lot of equity. In 2008, most homeowners did not have any equity. Right now, the inventory is anywhere from 3 to 6 months, depending on where you are. Texas could be 6 months, but California could be 3 months. So it's 3 to 6 months range. Whereas in 2008, there was 11 to 12 months supply. And also, unemployment was terrible. A lot of people were unemployed. Currently, a lot of the people are still employed, although we hear that a lot of big corporations, especially the Fab Seven, the Googles, the Metas, Apple, Amazon, UPS, Starbucks, Walmart, all those big companies are laying off by the thousands, by tens of 15,000. So we are hearing a lot of layoffs, but they haven't come in yet. So comparing 2008 to 2026, it's two different markets. So I don't see a crash coming, certainly not a 50% price drop. And we're just going to have to wait. Sorry to say that. Let me know what you think in your neighborhood when the foreclosure is coming, or what's happening as far as inventory goes. Do you have a lot of inventory? Are you selling your home? We are hearing reports, we're seeing reports that a lot of the sellers are delisting their properties. They cannot sell their properties, so they are delisting it. Yep. Okay. Okay. So let's move on. I'm going to show you another article. I'm going to share another article here. Let me remove this article. Let's see, and add another one. Let's see. Share screen. Okay. This is from another article. It's from Nerd Wallet. So the opposite side, and this article came out in November 18th, 1 week before the other article came out. The one we just saw with Melody from Newsweek says that there's a market crash coming in 2026. Home prices could go down as much as 50%. This article came out from Nerd Wallet, says that 2026 housing market dash stable rates, rising cost ahead. The new year could pose challenges for homeowners as well as home buyers. So let's say what they are saying. Again, this article came out just about 3 weeks ago. I just want to make sure you can read it. So thinking about making a big life change in 2026. Well, buying a home is a lot like getting married. Well, I'm really interested in this one. The planning seems to take forever. Everything's more expensive than you thought it would be, and stress can quickly reach, should we even be doing this, levels. I don't know if I thought about this when I got married, but that's a whole new webinar here. All that leads to a single day, closing day for buyers, or the wedding itself that goes by in the wink of an eye. And that one day isn't an end, it's a beginning. You're now a spouse or a homeowner, and that brings new responsibilities, joys, and challenges. You've reached a major milestone, but it's only the first big step on this journey. This article's got me really interested. Let's see where they're headed. It's a different take on this article. This coming year, it's going to be vital that prospective home buyers think beyond closing day to their lives and budgets as homeowners. Those who already own homes have plenty to consider, and there's news for renters as well. Here's what to know going into 2026. Mortgage rates remain fairly stable. Well, it's good news that the mortgage rates are stable. In fact, it's great news that the mortgages have dropped, because what that has done is that in the last few months after the rates dropped under 6.4, they're around 6.2 right now. I think there was a Fed meeting today, or there's a Fed meeting tomorrow. They expect interest rate to drop further as we end the year or as we begin the year. But because of the rates drop, there's been more applications for new home purchases and applications for pre-qualification. So that's a good news. So as like I mentioned earlier, Sun Belt, all that Sun Belt, starting from Florida, Texas, Louisiana, all the way down to Arizona, prices are actually dropping, depending on the area, of course. There's a lot of inventory. So if the home prices drop, if the interest rates drop, a lot of the buyers who could not afford, all of a sudden can afford. So the affordability has gone up quite a bit, which is good news. Will 2026 be the year mortgages drop to 3%? Honestly, let's hope not, because mortgage rates that low probably means something economically catastrophic has happened that's on par with the Great Recession or the pandemic. Let's go to the next paragraph. I'm going to jump on the mortgage. We already know this dropped. We are expecting it to drop, and let's see what happens. Home price growth slows, but other costs accelerate. This is a big factor. I just did a video last week talking about once you become a homeowner, it's becoming difficult now than it was before. For all the focuses on mortgage rates effect on affordability, home prices remain a serious stumbling block. Prices rose astronomically in 2021 and then kept climbing. We're finally seeing price growth slow, though the level of improvement really depends on where you live. Looking at year-over-year price changes in September, real estate analytics firm Cotality observed double-digit percentage increase in smaller markets in Michigan, West Virginia, and Ohio. At the other end of the spectrum, at the other end of the spectrum, 7 of the 10 markets that saw the largest year-over-year price decreases were in Florida. We know Florida is taking a beating. I'm not going to beat up Florida because I always talk about Florida, but we know that it has taken a toll on it. So what this article is saying is that they're not talking about a market crash or price drops. They're talking about affordability. Rates are dropping. That means more buyers coming on the market. But they are warning and cautioning that there are other costs after you buy that you have to consider. And what are those costs? One of the reasons I mentioned earlier that there's up to 2 million homes that are in default right now. Most of those are the homes that were bought 1 or 2 or 3 years ago. And there's two key reasons why they're having difficulty paying the mortgages, assuming they still have the job, assuming if 1 or 2 of them have lost jobs. Of course, if there's married and one of them lost a job, they may have a difficulty. But assuming that they're earning money, they have a job, the difficulty they're having is a combination of several things. One is that their property taxes have skyrocketed. So the escrow account that you pay every month, it might have gone up by $200, $300, $400 a month because the property tax increased. Furthermore, insurance has increased significantly. My insurance in the last 2 or 3 years have gone up 30, 40, 50%. Haven't even checked because what's the point? It keeps going up and I need insurance, so I keep paying. So my property taxes has gone up. My insurance has gone up. I have a homeowners association, not one, but two. They've both gone up. So if I was paying a mortgage, which I am, I can easily see 300 to 500 to 600 a month increase in my mortgage payment if I count the insurance, auto insurance, home insurance, fire insurance, earthquake insurance. Then I have the property tax increases, and then I have the 2 HOAs. So I'm sure I'm over 500 a month increase for sure. Luckily, I've been able to pay it, so I'm not in any trouble. But that's a significant amount of money, especially a lot of the people are on fixed income. I'm not on fixed income, but a lot of the seniors, a lot of people are on fixed income, and they don't have extra reserves or savings or disposable income like many others have. So they may be into trouble. And there are a lot of people, especially seniors and boomers on fixed income, that are having a hard time making a living today, even in California, let alone other states. So things are changing as we go along. Tough times seems to be coming along, but nowhere close to a major recession like 2008. That's just my opinion. Let us know what you think, what's happening, what your opinions are, and we'll be glad to share what you say with others. And again, if you are on Facebook or Twitter, which is X, or on Instagram, make a note or just say hello so that I know that when you make a comment on those, I can respond to you, because I'm not sure if I can see those on the software that I'm using right now. So anyway, let me carry on. The next thing I want to talk about is let me not share this. I want to share another screen. And what this, let me see here. Stop screen. I'm going to share one more screen. And this screen is very interesting because it's from the National Association of Realtors. I'm a member of this association for the last 30 years. To be a realtor, you have to be a member of the National Association of Realtors. And what they're saying, contrary to what the Newsweek article is saying, contrary to what the last comments were made, they're saying that, and by the way, this just came out on November 14th as well. So all these articles came out 2 or 3 weeks ago. NAR forecast home sales expected to jump 14% in 2026. Mortgage rates are expected to ease to roughly 6% next year. Let us know, what do you think? Are the rates going to go up? Do you feel they'll go down to 5.5%? Let us know, because if it goes down to 5.5%, we'll have a totally different real estate market. A lot of buyers will come into the market, and that'll actually make the prices go up. By the way, before I read further, what they're saying here is expected to jump 14% in 2026. What they're saying is not a price jump of 14%, but what they're saying is that the number of homes sold will be 14%. I believe this year we're going to end up with about 4.7 million homes sold. Last year we were around the same, around 4.7, 4.8 million. Now they're saying next year it could be close to 5.5 million. And at the peak time, I believe 2023 peak time, there were 6.2 million homes sold. So we are significantly low. We're well 1.5 million homes per year low last 2 years, but it's going to go up. But I've seen other reports. I've read other reports, genuine reports, and they are all saying that next year the prices will go up. Not only next year, but they're saying that in 2026, 27, 28, 29, up to 2030, prices are going to go up nationwide. Of course, that's an average by 1 or 2 or 3% per year. So not a drop as mentioned by the Newsweek article with Melody Wright. So I'm not sure why there's a big contradiction. And that's why I want to bring up this article, because there's a big contradiction between two articles, and they're both reputable companies. It's not like one is a cheapy company. These are both reputable companies. So let's look at what NAR is saying. Houston, November 14, 2025. Existing home sales are projected to rise by around 14% in 2026, according to National Association of Realtors Chief Economist Lawrence Yun. Yun delivered his 2026 housing in Houston. I'll move on with that. Yun said the expected rebound reflects easing mortgage rates, continued job gains, and improving market stability after several challenging years. Home prices are forecast to increase by 4% next year, supported by steady demand and persistent supply shortages. Next year is really the year that we will see a measurable increase in sales. Yoon said, home prices nationwide are in no danger of declining. See, this is a direct conflict, or a direct opposite of Melody Wright is saying, where they're saying in 2026, there will be significant price declines. So I have a question, whether you're watching live or you're watching a recording after this. Where do you see the prices going up or down in your area? Let us know. Clark is saying, Clark the realtor, Devon, is saying that I feel the rates might remain steady next year, hover around high fives, low sixes. Yeah, I think, I have a gut feeling. Of course, I'm going by gut feeling. I have no data, but they need to keep the rates low, at least not over 6.2. But if they can keep it around 5.5 to 6%, or even 6.2 range, we will see a strong housing market. A lot of buyers will come out and buy. A lot of investors will buy, and it will be a great market. And all the other thing, the good thing about the interest rate, one of the best things that's going to happen with the interest rates drop is, I mentioned several times that the inventory has been going up, but it's way below the normal levels. And one of the main reason inventory of homes for sale has been low is because of all these homeowners. I would say 90% of the homeowners refinance, those who have mortgages, even if they did not have mortgages, refinanced or pulled out money at 2 or 3 or 3.5% interest rate. So what happened in the last 2 to 3 years, including myself, I have a 3% interest rate fixed. I'm not selling my house and go buying something at 6%. And what happened last year and a year and a half ago, rates were at 7%. So the sellers were saying, nope, 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 absolutely not. They're not going to sell that 2.5, 3.5, 4% rate and go to a 7%. But now that they have dropped, and now that they have paid a lot of principal into it, they're willing to let go of that 3 and 4% and willing to go into 5.5, 6%. So that's another prediction that as the rates go down, more sellers with golden handcuffs, with the low rates, will come out and sell their home and buy another one, or pull out more equity and buy a rental at 5.5, 6%, 6.2%. In fact, I just sold a house, and it was a rental, and they used the home line of equity to buy it because they got a good rate on the equity, and they're going to refinance when the rates drop anyways, because it's an investment property. So yeah, a lot of things to consider. So let's look at the article. Let me see NAR here. Okay, let's see here. Mortgage rates are projected to decline modestly, averaging around 6% in 2026. Yoon emphasized that while rates are influenced by more than Federal Reserve decisions alone, broader economic factors are contributing to gradually lower borrowing cost. As we go into next year, the mortgage rate will be a little bit better, said Yoon. It's not going to be a big decline, but it will be a modest decline that will improve affordability. It's all about affordability. Lower the price, lower the interest rate, the more affordability they have, the more buyers there are. So, buyers will see the greatest affordability improvements in regions where new housing supply is most robust, particularly high construction markets like Houston. Expanding inventory in such areas will help more first-time buyers achieve their home ownership dreams. So, lots of information there, a lot of contradictory information than what the other articles were saying. Um, I made a couple of notes here, so I want to read those out to you. So again, there was another article I mentioned to you earlier that home prices are going to go up anywhere from 2 to 4%, depending on where you are, for the next 3 to 4 years, not just 2026. Let me know if you agree with that or don't agree with that. In your area, the home price is going to go up or down, or just going to stay stable, because we'd like to find out and share with others, when you look at those housing market, because some people may be moving from California to Houston, or go to Wyoming, or go to Iowa, or somewhere, and depending on where there's more inventory, where there's more deals to be made, they may move over there. Of course, they have to look at the weather and other things, jobs and things like that. But I'm going to read further, talking about Houston again here. Further over here, NAR saying that Houston is creating more home construction and therefore making home prices much more reasonable. The more homes for sale, the more the competition, the better the price. That's, uh, housing 101. Okay. Given the job creation, buyers will inevitably be showing up to Houston once the mortgage rates go down. So, Houston, here we come. Jessica Lotz, NAR Deputy Chief Economist and Vice President of Research, presented insights from newly released 2025 profile. So let's look at the profile. Lotz noted that the typical age of a home buyer today is 59, and the typical age of a repeat buyer is 62. She also shared that the number one reason people move today is because they want to be closer to family and friends. I call this the grandbaby effect, Lotz said. This is a different type of buyer. There's also a report. In fact, I was just about to say, but it says in the next article, it talks about who the first-time home buyer is. In contrast, first-time buyers continue to face steep challenges, with the share of first-time buyers hitting an all-time low of 21%, and the median first-time buyer age is reaching at 40. So for the first time in history, the first-time median age is 40. I remember it used to be 30 years. When I bought my house, I think I was around 28, 30 years old, 30 years ago. Lots of white hair. But now it's 40. And one of the reasons the median age of first-time home buyer is going up is because it's taking them longer and longer to save money. It's taking them longer and longer to pay off debt, especially students who have student debts. There's medical debts, there's other debts, private money debts, and it's taking longer to save money, and it's taking longer for them to settle down. A lot of these new people or newer people, they want a job, but they're not sure where they want to go. People move more today frequently than before. They work for 2 years, they want to go to Texas. They work in Texas for 2 years and they want to go to Florida. So they move a lot. So it's taking them longer to settle down. So they don't want to buy a house and they don't want to get stuck in a house. During my times, when I bought my house, I decided I opened up a business. It was a retail business. I opened up and I could only afford a condo. I bought a 2 bedrooms, 1.5 bath condo in 1989. It was listed for 165 and I could barely afford it. But I opened up a flower shop, and the same month I bought a house, took a big risk because I knew that I was not going anywhere. And then I also made a decision that when I move up, I'll sell the condo and buy a house. And that's exactly what I did. So, but what people do today is they move around, they rent, and they blow 3,000, 4,000, 2,000 a month in rent instead of saving or building equity or paying towards your principal, they're blowing away. And that's one of the reasons. Also, the moving cost them a lot of money. They have Hulu bills, Netflix bills, internet bills, latest mobile phone bills, latest shoes. They spend a lot of money. They spend a lot more than what we boomers used to spend. We were conservative. We saved money. Young kids today don't save money, or the rate of savings is slowing down, and that's why it takes them longer to buy a house. And that's why the first time home buyer profile is 40 years old, not 30 years old. I hope in 10 years it doesn't get to 50. The way things are, these millennials, they're not going to buy a house, they're going to rent. That's the new American dream. Just on a side note, based on reports I've read. So I hope this is making sense. Let's see, we have a comment here from Max. Thanks, Max, for your comment. It says here, hope you're right. I've been waiting for 15 years now. I make top 8% US income and can't afford a Section 8 dump where I live. Sorry to hear that. You've been waiting for 15 years to buy a house. Wow, that's a long time. I wish you bought 15 years ago, but I'm sure you had your reason not to buy. Yeah, home prices are not dropping anytime soon, according to reports that I read, not according to Mallory Wright. But yeah, if you can save up and do anything and maybe the rates will drop, that may be a reason for you to buy. Let me see here. I'm going to write a note yet. Max G6587. Okay, I just made a comment. So yeah, that's sad to hear that you've been waiting 15 years, but if you can save up more, and I hope you've looked into the FHA home loans, which is the government loan where you can put as low as 3.5% down. And I'm not sure what state you're in. I'm not sure what your income level is. Let me just give you an example. Earlier in the report, they said that the homes between 100 to 250,000 homes are selling right now. So let's say you want to buy a $250,000 house. I'm not saying you will buy, but if you buy a $250,000 house, and if you get an FHA loan with a 3.5% down, you're looking at about $8,000 in down payment. Plus, you're going to need closing costs. You might need $2,000, $3,000, $4,000 in closing cost. You could ask, and when I say you, I'm giving you an example, Max G6587 and others viewing, just giving you an example on a $250,000 house, or let's take a $400,000 house. If you get an FHA loan around 3.5%, you're looking at a $14,000 down payment. You have several options. You can ask the seller to pay for the down payment. You can ask the seller to pay for closing cost. You can negotiate and price it in such a way that this happens. So you could buy a house with $4,000, $5,000, $6,000 if the seller cooperates. You may want to talk to a realtor. I have a network of realtors. If you want to talk to realtors who knows what they're doing, how to buy a house with low down, direct message me, send me a message, and I'll hook you up with a realtor. Clark, the realtor, has another comment. It's hard for younger to save nowadays with inflation and income not keeping up. Most of their paychecks going towards their expenses, leaving them little or none to save. We got to hope the incomes go up. You're absolutely right. In Los Angeles County, and this includes renting and mortgage, on average in the Los Angeles County, especially in the metro, near the metro areas, almost 40 to 50% of the paychecks goes towards housing. You're talking 50%. That means if I'm making $10,000 a month, I'm paying $5,000 just in rents and principal and interest. That doesn't even count your utilities and your insurance and your auto and your medical insurance and food and diapers. So yes, it has been very, very, very difficult for the youngsters, for the working generation to save up any money, because in metro areas, like I'm in Anaheim Hills, and in Orange County, a two-bedroom, 2-bath condo, which is about 30 years old, will cost you close to $3,000 a month rent. A 2-bedroom condo, 1,000 square feet, 1,200 square feet, 1,500 square feet, depending on how old it is, what they have, if it has a washer dryer inside, if it has a 2-car garage, how old it is, how updated the community is. it can go for up to 3,000 a month. It is very, very expensive. So if I'm a new guy, a millennial, just got a job, and I'm making $10,000 a month or $5,000 a month, half the paycheck is gone towards rent or utilities, or if I have a house, for principal, interest, tax, and insurance. So it's very, very expensive to make a living. And that's one of the reasons it's very hard for them to make a savings. Not only that, medical costs are very high. And then what's happening is everything else is high. You go out to eat, you go out for grocery shopping, it's cost you an arm and a leg today. It's very, very expensive. You go to a fast food restaurant, and what the average bill in a fast food today is $16 for a combo. In a fast food, to eat junk food, you're paying 16 bucks. If I go for lunch today, used to be lunch, I could do lunch for 12 or $13. Today it's $20 just for lunch, a sandwich and a drink. It's ridiculous. So it's very hard. I totally understand. It's very hard to save money. Furthermore, the home prices have gone up. So the $400,000 house we talked about 7 years ago, it used to be 300,000. So now, instead of coming up with $412,000 down, you may have to come up with $15,000, $16,000, $17,000 down. So the amount of money you have to come up with have gone up as well. So yes, very difficult. And the other thing that has made home affordability expensive is when you qualify, they look at your principal and interest payments. They also look at your taxes and insurance. And guess what has happened nationwide? Property taxes has not gone up. It has skyrocketed. Insurance has not gone up. It has skyrocketed. So if you were making $10,000 a month and you qualified 2 years ago, they might say, okay, Mike, you can buy $800,000 house. But today, with the same income, I may just be able to buy a $700,000 house because my property tax and insurance gone up. So my debt to income ratio has gone up. So the amount of home I can purchase is a lot lower. So things have really changed. It's very hard to buy a house today. It's very hard to make a living. But then again, we're in a tough situation. We're in a tough economy. We're in a tough political situation. And all of that is piling up. And we just don't know where it's going to go. But I won't talk about those kind of things right now. But that's where we're at. So I want to end by a few things. And I know I've seemed like I've been negative, and I've been negative and negative. But if you are, I'm going to remove this. If you are a seller or if you're a buyer, what are some of the things you could do in this market or in this upcoming market? So I want to talk about some of the things, and I'm going to share with you. Let's talk about the seller, okay? And I'm just going to give you some brief points. And by the way, you might have seen me that I'm looking at notes. I'm old school. I like to print it out, so it's very visible because I'm using my laptop to do this video. So I'm old school, but it works. So let's talk about the home sales, what you should do. First thing is get a real valuation of what your house is worth right now. And if you're thinking about selling, what it may be worth next year. If you're in Houston, for example, next year, your house may be worth lower. In Austin, your house may be worth lower, but in the northeastern states, your house may be worth more. So plan ahead, start planning ahead, talk to realtors, talk to lenders, and plan ahead. See how much equity you have if you want to sell. And then based on that equity, if you want to move somewhere and buy something, figure out if you're going to move to Florida or anywhere you want to go, how much of a house you can buy. So you need to plan things ahead. The more equity you have, the more house you can buy. So you need to clarify, you want to buy in 1 year, 2 years, 3 years, sell and buy, or just buy. The other thing you want to start doing is, today sellers are asking for top dollar. They want the highest price. So you need to start preparing your home so that it has good curb appeal. Things are working properly. Your dishwasher is working. Your AC is working. Things are in proper working condition. You can take weekends or a little bit at a time, do your landscaping, do your yard, do some decluttering, do some depersonalizing, do little things. So when it comes times to sell in 6 months or 3 months or a year, you are ready, and you are ready to go. You know where to go, how much you can afford, how much you're going to be able to sell, because you've talked to a lender, you've talked to a realtor, you've talked to your accountant. Wherever you're going to move, you've checked out the prices over there, how the market is over there. So you need to prepare And the best way is talk to a lender, talk to a realtor, and I'll be glad to refer you to one wherever you are. So direct message me and I'll refer you to a top agent in your area. um, Also know what your local trends are, what's happening in your local zip codes. Are homes sitting there for a while? Is it taking longer to sell, or is it selling faster? Are buyers showing up at open houses? Are buyers negotiating, or are they paying full price in your neighborhood? I just sold a house. It sold for like almost 1.85. It was an income property. It was listed for 1.95. We got it for around 1.85 range, but there were multiple offers on it. So we offered them $200,000 less. But because there were multiple offers, we had to come up higher because there were multiple offers. So Orange County is still strong in certain areas. So you have to be very prepared. Uh, the other thing is, what is the local data going to do? What are the interest rates going to do? Although you cannot predict it, you know where they're headed. Are they going up or down? Because if they go up, then the buyers will not buy your home, or there'll be less buyers. At the same time, if you want to buy, will you pay 7% and let go your 3%? So you have to plan ahead. So it's always good to know how much you have in your equity, know your timeline. You have to price it realistically based on your market and the season, and then watch what's happening in your zip code, in your neighborhood. Uh, there is no perfect time to sell, just like there's no perfect time to buy. The perfect time is when you are ready, willing, and able to buy or sell. A lot of the buyers, a lot of the sellers chase the market. I have two friends. They've been chasing the market for the last 2 years. I told them 2 years ago, buy now, buy now, buy now. They haven't bought. Now they're regretting. Now, at that time, I was showing them $900,000 homes, 900,000 price range. Now those homes, the same homes, are selling over $1 million, and guess what? They can afford those. And now the homes that were selling for 800,000, which they didn't like, are in their price range. So because they were chasing the market, now they're stuck, or they're going to have to buy a lower home, or they're going to have to put more down payment and buy that $1 million home. So again, it's very difficult to chase the market. I never recommend, or highly not recommend, you to chase the market, because nobody can predict it. Look at these predictions we saw today. One is predicting up to 50% decline, according to Melody Wright, but NAR and others are predicting a 4% rise in home prices. Who do you believe? By the way, you may go to Zillow. Zillow has been wrong many times. In 2024, end of 2024, they predicted that home prices in 2025 were going to drop. Redfin said the same thing. Guess what? In spring, in April, May, Zillow and Redfin changed their prediction. They said now home prices were going to go up. So even those guys are wrong with all the data that they have, all the data mining that they do, and all the reports that they look at and research. They were wrong too. So go with your gut feeling. Don't chase the market. Be informed, be smart, be educated. If you're watching this, I'm sure you're watching this for a reason, because you're getting a lot of information, a lot of resources. If you want links to these articles, direct message me. I'll send you these links. I'll be glad to do so. And then coming back to the buyers, again, the rates may drop. And I have some people tell us, you know what, I'm waiting for a market crash to buy a house. Let's see. So if the market crashes, that means there's a lot of unemployment, there's a recession, economy is bad. What if you lose your job? What if your wife loses a job? Or if you're a woman and your husband loses a job? Can you buy a house then? So are you smart or are you dumb? Because in a bad economy, a lot of the businesses will lay off. So what if you lose a job? You won't get a house. So if you can afford right now, if you are ready, willing, and able to buy, it's a great time to buy right now. The best time to buy a house, or the best time to sell a house, is when your timing is right, when you are ready, willing, able to buy. It's like they say, when your stars align, that's the best time to buy. I know in the earlier article they mentioned about marriage. When's the best time to marry? Well, things will align. If you find somebody and your gut feeling says go for it, you go for it. You don't do any math when you get married. You don't see the income and the debt and all that. It's your gut feeling. Are you ready, willing, and able to marry and commit yourself to 30, 40, 50 years with your spouse? A house is your spouse. Are you ready, willing, and able to commit 30 years? 40 years, 50 years to the house. You're going to take care of the house. You're going to pay the house. You're going to clean up the house, just like your marriages. I guess it's the same thing. So hope these makes a lot of sense. We'll be back next week on Tuesday. If there's a certain topic you would like to listen or like me to put it out, I'm open to suggestions. Thanks for watching. Thanks, Clark the Realtor, for watching. If you're watching this recording, please ask any questions. And if you can follow and subscribe, I would really appreciate it. Mike Patel, see you next week.